Hey, what's going on, guys? So in this video, I wanted to give you my quick portfolio update, what I've been doing with my capital, and also talk about how to deploy your capital in the current market situation, what strategies I would personally use based on the risk and reward and where we are in the market right now. So let's dive right in. I've increased my Bitcoin allocation pretty significantly compared to like 2 years ago. If you just go back to my previous videos, I'm just stacking Bitcoin more and more consistently. And that has been kind of like the main weakness in my portfolio because I never really held that much Bitcoin to begin with. I got into crypto through NFTs, so I had much more ETH and much more NFTs. I still hold some NFTs, but we removed the tracking for it a couple months back because NFTs are down pretty bad and it's not really an accurate representation of my LP and yield farming portfolio. So if we go back to the previous month, I was still holding some MON and I was yield farming that paired with USDC. I decided to exit that position to buy some more Bitcoin. And with the Bitcoin that I bought, I'm using a covered call strategy using options to generate some yield. So if I sell a covered call and if Bitcoin moves up, I'm going to be making a US dollar profit and I'm happy to sell Bitcoin at the strike price that I chose. So that's what I'm doing with that portion of my portfolio. And I also had a bidding LP for Hype to USDT. That is mainly in stablecoins and it's not really fluctuating that much, but the yield is not that great as well. So I decided to buy some syrup and pair it with ETH in the LP. So that is this syrup to ETH position here. And you can see my LP position is getting more and more balanced, probably a little bit more heavy on Hype and Bitcoin, which thankfully has been doing quite well over the last few months. And that is allowing me to accumulate some Bitcoin and some Hype. So thanks to that, I was able to accumulate about 200 something dollars worth of Bitcoin with just about like 15K worth of capital spread out between those two pools. So those two pools have been doing quite well. The only downside with my portfolio currently is just that some of the assets like Pixel has been retracing pretty aggressively. Currently, it's trading at only 0.0065. Where during the bull market, it was mainly ranging between 5 cents to 10 cents, right? So it has retraced pretty aggressively. I definitely should have taken much more profit, but at the same time, I've also made a lot of fees and cash flow from my Pixel to ETH position all throughout the bull market that I was able to use to accumulate these other assets. But yeah, over the last year or so, I think I started with less than like 0.05 Bitcoin, but now I'm at about almost 0.35. If you include this UBTC that I'm pairing with Hype, with this other types of BTC here. So some of it is raw Bitcoin and some of them are stuff like wrapped Bitcoin or Coinbase Bitcoin that I could use in DeFi if I wanted to. And another major change is that I've basically deployed most of my stable coins. If you look here, I only have $100 something worth of USDC that is being paired with ETH. So it's very little. And then there's also very little USDT here that is being paired with Hype. So it's these two LPs here, and according to Metrics Finance, I'm going to be earning about like $500 to $600 per month, and that's roughly what I estimate as well. So not as much as during the bull market, but still a pretty decent chunk, and I've still been able to retain most of my earnings because I do run a wider range and a more conservative strategy compared to people who are squeezing the range. A lot of times their number for versus holding is going to be negative. And depending on how you're managing your position, you could easily lose a lot of money in the process as well. So these are basically my main LPs. I believe Syrup is trading at a pretty good value. When I was sharing with the Drippy community, the price was a bit better. The valuation was at 15x fully diluted value when divided by the annual revenue, which is pretty good in my opinion. And in the past, it has been hovering between like 20 to 30x. So the altcoin market has been pretty weak. That's why we're seeing pretty good valuation and pretty low multiples that we could be looking to buy some assets in. And I'm pretty confident in Syrup. And of course, this is not meant to be financial advice. Please do your own research. But in my opinion, Maple Finance have been doing a great job. Their revenue has been sustaining. Their total value lock has been sustaining, even though the market has been weak. And I think institutional DeFi and lending and borrowing is just going to keep growing. So I'm comfortable buying and holding Syrup and LPing Syrup. And they do buy back the token as well. And they don't have a separate equity structure that is in direct conflict with the best interest of the token holders, right? So that's why I do like syrup, and this is the range that I set. You can see the orange lines. And I do prefer a wider range strategy. This is a little bit tighter than what I actually normally go for, but it is as tight as I would go. If the reason why is because I do expect lower volatility here during the bear market. But at the same time, if you look at the previous price action, it's typically bouncing between these two ranges. And a lot of times I don't want to be in a situation where I'm out of range too quickly. And if I'm chasing the range up and down, I could lose a ton of money in the process, right? So it's just much easier and much more profitable, in my opinion, to just set a range that you could stay in range for at least 6 to 12 months at a time. And if you want to join Drippy, feel free to check out the link down below. That's the best place to ask me questions and get access to our courses and our software and stuff like that. We are having a founding members discount right now. So if you're the first 100 to sign up with the discount code, you will have a lifetime discount. Now that the shameless plug is out of the way, let's kind of dive deeper into these positions. I'm still holding these UBTC and Hype positions because I really like Hype and Bitcoin. I do expect Hype to outperform Bitcoin if they keep doing a great job with the project and keep making revenue. And I don't mind going out of range to the upside because that allows me to stack more Bitcoin in the process rather than just straight up and dollar cost average Bitcoin, right? Of course, there's a risk of Hype underperforming Bitcoin and I'm left with a lot of Hype. That is also a possibility. That's why I'll also hold a bunch of Bitcoin on the side as well. And I do plan to accumulate more and more Bitcoin. And I am holding this ETH to USDC position with a maximum bullish range just so that I could get much more capital gains out of my assets if the market does reverse to the upside. I don't have to worry about managing my positions too much. I just compound into the position and sometimes I add additional capital into that position as well. So this is meant more for like capital gains and a nice solid APR over the long term. The APR is higher than this if it's able to stay in range, but we did pop out of range for a little bit. That's why the APR has been a bit lower. And this is that wider UBTC and Hype setup. And typically, I do like to have more capital in the wider range rather than the tighter one. But in this scenario, I had a bit more in the tighter one just because I want to bump up my portfolio APR just a bit. So this is called the nested setup. I really like this setup because one of the positions is going to be in range for longer and I can stay in range for a very long time while earning a nice APR in the process. The current APR for this UBTC and Hype pool for a pretty wide range is about like 9 to 10%, which is really good compared to just using your Bitcoin somewhere else, right? A lot of times it's pretty hard to generate a good 5 to 10% on your Bitcoin. So I'm pretty happy with this. And I would be gaining more Bitcoin in the process as long as Hype retain its value against Bitcoin or outperforms it. But again, because the market has been pretty weak, assets like Pump and Pixel has not really been doing well for my portfolio. So that's why my portfolio has been drawing down a little bit. You can see in January and February, I did inject some additional capital here and I logged it. But in March, I didn't really add any outside capital, but because Pixel was trading a little bit higher in February. Same with Pump and Pendle. That's why my portfolio did draw down a little bit. And if you guys are investing into crypto or you're trading crypto, a drawdown is just part of the game, right? You just got to manage the drawdown. You got to stomach it and hopefully the market reverses. And then we're going to see much more gains as the prices are trending up once again. So that is the overall look at my DeFi portfolio. And one of the guys on YouTube was asking how to deploy capital into the market given the current market condition right now. So we can start by looking at the price of different assets and see where we are in the market right now, right? In my opinion, Bitcoin is pretty cheap already at around like 68, 69K. In the last bear market, we did roughly bottom out at the highs of the 2018 cycle. Maybe we are seeing that as well. I'm sure a lot of investors are looking at this chart and then say that maybe this is where the support is going to step in and they're already deploying capital, right? So in my opinion, it's a great time to be accumulating crypto asset. Of course, we could always go lower, but if we go lower, then we just got to find more ways to access more cash and then buy more Bitcoin and buy more assets as prices are low, right? And assets like ETH or Solana, I think the prices are quite low already. There's no need to be like shorting the market at this point in time or using protective strategies, in my opinion. just because you could minimize some drawdown, but also with the protection, a lot of times you are going to be giving up a lot of the upside, right? So for me personally, I am mainly focused on maximizing the upside. That's why you see me deploying stablecoins pretty aggressively into the market. And I'm not really worried about holding a drawdown from this point in time. Even though it is possible that ETH is going to drop from 2K all the way down to 1K, and then I would technically have a 50% drawdown, but I still have income coming in on the side as well as some cash on the side to deploy if I really need to. But whatever's in my wallet right now, I'm pretty much chucking it into crypto, whether it's like crypto to crypto pools or just raw Bitcoin and stuff like that. And it's pretty hard to give a blanket statement on which strategies are the best because it depends on the assets and it depends on how much yield you're able to generate. And it depends on the risk and reward for that particular asset as well as the price of the asset that it's trading at, right? For example, I'm pretty bullish on hype, but as prices are climbing up, the risk and reward is just not going to be as good as before when prices are cheap, right? So there's a lot of nuance to it, but the first thing that we need to make sure is that which assets do we want to actually accumulate? A lot of our community members and our clients, they do want to stick with more blue chip assets, stuff like Bitcoin, ETH, Hype, Solana, maybe BNB. And these are probably what you want to be basing your yield farming strategies around. And you can reserve maybe up to 20% of your portfolio into altcoins that are higher risk and potentially higher return and maybe higher yield as well, right? But if you're going over that 20% mark, then it drives up the risk of your portfolio pretty significantly. My personal portfolio is pretty high risk because I do invest into TradFi assets and I also have some cash and some other things on the side. So I'm pretty much protected if anything happens to my high risk assets like Pixel or like Pump. I don't really mind losing money on those because those are higher risk and higher reward plays for me. So you got to decide which assets you're comfortable with and what type of risk you're comfortable with, right? Are you willing to take more risks when yield farming, or are you trying to look for more consistent returns and more sustainable strategies? If you are squeezing the range with a lot of strategies, it's just not going to be as sustainable and it is pretty high risk. And the chance of you losing money is much higher. So you got to be really clear where the risk lies for each strategy. There's always a trade-off that we have to make. It's very rare that you're going to get really, really high reward, but then the risk is going to be very low. It's just very hard to do that, right? But that's the first thing that we need to kind of ask ourselves, what assets are we comfortable with? And then which assets you want to accumulate? What's the risk profile? And stuff like how much drawdown can you stomach, right? So let's take a look at building a custom portfolio right now based on maybe your risk profile or just a custom template that is a good fit for most people. And I've helped a bunch of clients build their TradFi and crypto portfolios before. What we typically want to do in most cases is just not take a crazy amount of risk because you could lose a bunch of money in the process. And when you lose money, it's just going to be harder to recover. Unless you're like me, where your age is pretty young, you have other assets that you could rely on in case crypto doesn't work out, then by all means, you could, take a bigger swing, right? But at the same time, just because we're risking more doesn't mean that we're going to make more at the end of the day. But let's say you're building your portfolio from scratch. One of the things that I wish I had done is just hold more Bitcoin. So you could possibly think about holding maybe 50% BTC. And that's probably where I want to go to as well in the future. And maybe 25% ETH is also a great idea. And then the rest could be alts and stables, right? So this is a pretty good allocation, in my opinion, for most people. And you don't really want to be going over like 25% unless you're going to take much more risk and you don't mind losing your portfolio, then that is also fine. But if you're looking for a more passive, more beginner friendly portfolio, this is probably what I would roll with. And in terms of actually deploying into the LP, we need to think about our LP allocation as well. When prices are cheap, there's a few strategies that have much better risk and reward. For example, you don't want to be yield farming delta neutral strategies because those strategies are typically designed to protect the downside of our portfolio, to reduce the volatility of our portfolio. When prices are really high and there's a lot of euphoria, a lot of hype in the market, that's typically the best time to implement those strategies rather than like when the prices are cheap already. Maybe we're going to go lower, but it's not a guarantee. And so if we are trying to maximize our upside here, maybe we could put like 50% of our portfolio into crypto to crypto pools, right? And you don't really have to use leverage if you don't want to. In fact, if you're a beginner, using leverage could cause you to make mistakes and you could lose much more money in the process rather than not using any leverage. So using more crypto to crypto pools like ETH to wrap Bitcoin or ETH to Coinbase Bitcoin, or pools like Hype to UBTC, like what I am yield farming right now, or other altcoins to ETH pair is also a great strategy, right? So you could do that. And again, you can adjust the ratio to however you want and depending on your risk profile. But in my opinion, crypto to crypto pools do typically have a pretty good upside compared to stuff like crypto to stable pool. And maybe if you are more advanced, you could also allocate some to leverage strategies. So maybe the bull lever strategy that I share on my channel. If you don't know what it is, just search for bull lever on my channel. Basically, we're lending assets like ETH, Wrap Bitcoin, Coinbase Bitcoin on lending and borrowing platforms like Aave or on Morpho. We're buying some USDC and then we're using that USDC to yield farm. And typically, I like to pair it with crypto to stable pools because they tend to pay a higher APR and because we don't have to worry about missing the upside for this strategy. I could squeeze the range a little bit more as long as I don't borrow out too much capital. And you can see how I'm limiting like the bull lever strategy to maybe 25 to 50% of my portfolio, simply because if I have other positions and other strategies, it's much easier to deleverage if I really need to. So if Bitcoin is crashing to like 50K, 40K, and I want to deleverage, I can do that very easily. Or I want to add more collateral, I can easily do that with these other strategies, right? And these other strategies are going to be earning fees in the meantime too. So if I want to decrease my risk, then I can repay the loan more aggressively, drive down that risk. And then basically after a while, I've locked in a bunch of profits through that scenario, right? So a bull lever strategy is a pretty good risk and reward in my opinion. And if you want to have a little bit higher cash flow, you could consider using some crypto to stable pools like I am as well. I have that Hype to USDT pool. I think the yield is not that optimal on that pool. The better one might be Hype to USDC. I just haven't moved it over yet. But I also have that bullish ETH to USDC LP that is designed to dollar cost average out at a better exchange rate because I'm setting a wide upper range and I'm earning some nice fees in the process. So this is a great strategy and a pretty good allocation in my opinion for a lot of people at this current price. And you don't have to have any crypto to stable pools. If you don't want to, you could have it all to crypto pools. You could have some spot holdings as well. So you don't have to deploy everything into DeFi. And if you are allocating more capital into DeFi like I am, it's very helpful to use an insurance platform like Nexus Mutual to decrease some of the risk in case some of these protocols get hacked. And then lastly, we could think about lump summing or dollar cost averaging. A lot of times when the prices are cheap already, it's good to lump sum a portion or dollar cost average more aggressively. And when the prices are high, I typically like to buy slower rather than like lump sum all of my cash, just because I would be getting a better average entry if I buy more aggressively when prices are kind of low, right? And one strategy that you could use as well if you're not fully deployed yet is if you have these crypto to crypto pools, and as prices are trending up and down, you just dollar cost average directly into these pools. And that's a great way to get an average entry if you don't want to lump sum. But if prices are cheap already, I don't think it hurts that much to lump sum. But just keep in mind that if there's some negative catalyst, we could always see another like 30, 40, 50% drop, right? That is also a risk to keep in mind. It's not as painful if you have other assets and if you have cash or if you have a solid job, it would also help you cushion that drawdown. But hopefully that kind of makes sense and was helpful at a higher level. We want to kind of think about like which assets we want to own, what type of risk profile we're comfortable with, and what's the risk and reward at that point in time. And again, if you're trying to maximize upside, in my opinion, we should be focusing more on crypto to crypto pools. Strategies like the bull lever or holding spot on the side is more likely going to be outperforming delta neutral strategies, hedge strategy, crypto to stable pools if prices are trending up once again. Of course, we never know if prices are going to keep trending down. But in my opinion, as the price goes cheaper and cheaper, I just like to switch more to crypto pools. And if I want to use leverage, I could use the bull leverage strategy. So that's it for this video. Hopefully it was helpful. And if you want to watch more videos from me, hit the like and subscribe button. Thanks for watching. I'll catch you on the next one.